Hello guys, and welcome to MarketsGator, a channel dedicated to retail investors. Here, we are discussing and experimenting with different trading and investment strategies which retail investor can utilize. We are also checking the news, discussing developments, markets and trends. Disclaimer, this information is not financial advice. This content is for educational and entertainment purposes only. The authors of this video are not financial advisors. The information does not constitute financial advice or recommendation and should not be considered as such. Do your own research and seek independent advice when required. Always do your own research and seek independent financial advice when required. Creators of MarketsGator content are not liable for any losses incurred and assume no liability for your actions. The information shared is just personal opinion of authors. Relationships. When content is published about a company or organization with which MarketsGator channel has a commercial relationship or interest, that fact will be clearly disclosed in the video and/or in description. Today's topic is Graham number. Questions we are going to answer today are formula for Graham number. See how it works. Calculate the Graham number for several stocks manually. Next, I will try to create simple trading strategy using this formula, backtesting and see how the strategy would perform through the years. Check the backtesting results, including sensitivity to parameters and how does it behave for stocks from different sectors of the market. Draw a conclusion, what can be improved, what other experiments we can do, share my personal thoughts, what I believe are pros and cons of the approach. Let's start. The formula we're talking about today comes from Benjamin Graham's legendary book, The Intelligent Investor. This is how it looks like. It's a square root of product 22.5 by EPS by book value per share. Let's look what each letter and component stands for. V, Graham number, a fair value of the stock. EPS, it's earnings per share. BVPS, book value per share. The 22.5 multiplier represents, according to Graham, an ideal PE ratio of no more than 15 and a price-to-book ratio of no more than 1.5. Before moving to strategy, let's take several stocks and calculate their Graham numbers. The stocks I choose this time are Parsons Corporation, Nvidia, AT&T, and ExxonMobil. As usual, I strongly encourage you to do the same exercise yourself, choose the stocks you like and do your own research. To get the data like EPS and book value per share, let's open Yahoo Finance website and go to the page with company's details. Here is the page for Parsons. Here you can find the EPS, and in statistics, I can find book value per share. And here is the same for ExxonMobil, earnings per share. And on statistics page, book value per share. And I'm doing the same for other stocks. After plugging in the numbers, here are the results I've got. I also added additional column, price to value ratio. And the values there is the current stock price divided by Graham's number. Now, I will apply a simple rule to identify if stocks are fairly valued. If the ratio is less than 0.7, meaning that price reflects 70% or less of fair value, the stock is undervalued. If the price is 30% or more higher than value, I treat it as overvalued. And if the ratio is within the range of 0.7 and 1.3, it's fairly valued. According to these rules, I'm making a conclusion that Parsons Corporation, Nvidia, and Lyft are heavily overvalued stocks. And ExxonMobil, I'm treating as valued fairly by the market. Now let's try to create a simple investment strategy. First, a couple of assumptions. I'll limit my stocks universe to the top 500 stocks by market cap. And I'll keep the constant the same as suggested by Graham. Here is the strategy I will be following. At start, calculate Graham number of all stocks from universe, 500 top market cap stocks. Calculate ratios, price to Graham number for each stock. Select N most undervalued stocks ratio below inclusion threshold. Then, every M days, for example, every 1 month or 1 quarter, calculate Graham number and price to number ratios. Exclude from portfolios stocks where ratio above our overvalued threshold. Let's start with 1.3. Replace excluded positions with new undervalued stocks. For example, if 3 positions are dropped, we'll need to find another 3 stocks which ratios show that they are undervalued and add them. To backtest my strategy, I'll be using an online platform called Quant Connect. I was already showing it in my previous video, Graham's Fair Market Value. You can find the link to that video in the description. Here, I'm opening my account and going to the project which I created. To control how strategy is behaving, I'll need several parameters. Start and end date. This is our testing range of time. As you can see, I decided to start from January 2021 and up till now, which is more than 4.5 years. Initial deposit. How much money we start with? Let's set 1 million. Our benchmark is SPY S&P 500 ETF. We'll be comparing our strategy to buy and hold strategy of this fund. Rebalance frequency. How often we're checking for overvalued and undervalued stocks. Stocks count. How many positions I'll be holding in my portfolio? Let's start with 10. PE max ratio and PB max ratio. These are 2 values used to receive a constant of 22.5. Size of our universe? 500 stocks. Inclusion threshold, value of price to value ratio when we treat stock as undervalued, setting to 0.7, and exclusion threshold. When the ratio is above 1.3, stock treated as overvalued. I've also introduced a special parameter for minimum price to value ratios to exclude stocks with negative earnings per share and anomalies when due to reporting issues, the value is too high. Let's open first run, 10 stocks, and rebalance period is 30 days. Let's scroll down to results, and what do we see? Compounding annual return, 21.47%. This is really good. Drawdown, 24.7%. And net profit through the whole period, 150%. Next, let's try to increase the rebalance period to 90 days. It will be interesting to see if it will have any meaningful effect on the results. Okay, we see that annual return is 0.3% higher, but drop down also deeper, 26.5%, almost 2% more. Now, let's try to decrease the rebalance period to only 10 days. It means that every 10 days we'll be checking for over and undervalued stocks, and if needed, rebalancing our portfolio. Scrolling down, and we see that annual return again slightly improved. It is 21.78%. But now we have smaller drawdown value, only 24%. This is very good. In my next round of experiments, I'll try to increase the number of stocks in portfolio to 20 and do the runs for different rebalance periods again. Let's see how it will affect the results. This table shows the results for each run of our baseline strategy, and the best result shows the strategy with 10 stocks and rebalance frequency of 10 days. Please also note that on selected time period, each of them are beating the benchmark. This is a big surprise for such a simple strategy. This table demonstrates what is the contribution of each sector, and it looks pretty interesting. We can see that almost half of the stocks we selected were from financial services, another 23.5% stocks from consumer cyclical sector, Then goes energy with more than 11%. But stocks from some sector were actually never selected. These are communication services, healthcare, industrials, real estate, and utilities. This phenomenon still needs to be investigated. Maybe the market usually values them relatively fairly. Or maybe the conditions of under and overvaluations we are using, which are plus minus 30% from market price, are not applicable to these sectors. And we need to find other ranges. In my last round of experiments, I tried to find out what will happen if I'll be selecting stocks only from specific markets sector. To do this, I have a special parameter in my strategy where I can specify the sector I'm interested in. And then I'm making 11 runs, one for each sector, and comparing results. And here is the table with results for each sector. From very beginning, I see that none of these sectors can beat the baseline in terms of drawdown. As you can see, when we're selecting stocks only for specific sector, the drawdown is always bigger than for baseline strategy, which is 24%. Also, there are only 2 sectors where we see higher annualized returns. These are energy and industrials. One more thing. Take a look at technology. We know that for years these stocks are the driving force of the market gains, usually demonstrating good returns. But in this strategy, when we're trying to compare their fair value expressed as Graham number, they lag. What's more, the strategy here exhibits one of the biggest drawdowns, more than 57%. To me, this means that stock prices in technology sector is not really defined by either EPS or book value per share. Now, let's summarize what we learned. First, I'd like to admit that I'm surprised that such a simple strategy demonstrated such good results, even though it was over a relatively short period of time. It would be interesting to backtest it over a longer period, 10 or 15 years. It would be nice to see how this simple strategy will behave through different market cycles, interest rate regimes, inflation, and so on. The good thing about this strategy is its simplicity. I'm a big fan of simple solutions because there are more chances that they will fare well as time passes, and there are more chances the approach will be applicable when the markets change. The third thing I like about it is that it is focused on selecting stocks with good fundamentals, earnings, and book value. Let's also say a couple of words about what I'm treating as weak points of Graham number. First off, it relies on magic number. 22.5 is a multiplication of maximum price to book and price to earnings ratios. But different sectors maybe, and most definitely will, have other ratios. So to my taste, it's a little bit oversimplification. I like simple solutions, but one size fits all rarely works. And last one, it's basically its strength and its weakness to me. Graham number relies only on 2 numbers, earnings and book value per share. But there are many more dimensions which can and must be taken into account when valuing the stocks. But this is what Graham's book is about. It will be really short-sighted to assume that his whole valuation approach boils down to 1 or 2 simple formulas. That's why I strongly encourage you to read the book and make your own experiments. Always do your own research. That's it for today. If you like this video, hit like and subscribe. And if you want more videos like this, leave a comment what other investment strategies you want me to test. Thank you, and bye.